This is Townsend Asset Management's Capital Markets 2022 discussion. We are going to talk about where we are currently. We're going to review the concept of trying to time the market and some of the historical evidence of the difficulty in doing so. With the Fed further in or gaining greater attention, we're going to discuss data points there and what has happened in the past, at least as a reference point, and maybe what the market's expecting here in the near term. And then to finish, maybe lend more towards kind of some of our optimism here at Townsend and talk about the position of the consumer. The consumer being roughly 70% of GDP, with purchasing of goods and services. I think it lends a more positive light on what we can expect as things settle in. I'm going to share my screen with you now and get to the presentation. Okay, so I'm James Tarkington, the Chief Investment Officer at Townsend. Let's go into the presentation. So here's the S&P 500. It's over time. It's really looked at as one of the more broader measures of the equity markets, and as you can see, through February 23rd, we're down about 11.3% year to date. And after the performance that we've had, it may not be far to expect that we'd have a period of resetting, so to speak. But I do think it's interesting to at least pay attention to the extreme events of COVID-19, in which we experienced the fastest number of trading days to a bear market, which is at least 20% below the market's past most recent peak. And then the fastest return to a bull market, which is 20%, at least 20% higher from the market's most previous bottom. And what was really a true global problem with the pandemic and the world shutting down, and even getting through a presidential election, I think it's relevant to really look at how well the market has done under real pressure situations, as we consider the world that we're in today and some of the geopolitical things that we're dealing with, and potentially the impact of the Fed and the decisions they'll be making here in the near term. So we saw the price, and so what is the valuation? And we look at that. This is the S&P 500 forward PE ratio. So thinking about forward-looking, market's always forward-looking. So we're looking at forward earnings or expectations of forward earnings over the next 12 months. We're about 19.7 times earnings. Historically, you can see that 2000 we're at 24.5. And there's two aspects to this. There's earnings growth, and there's either margin or multiple compression or expansion. And from an earnings growth standpoint, for 2020, earnings were down 33% for the S&P 500 through September of 2021. So that would be the first 3 quarters of the year. We're wrapping up fourth quarter. Now, first 3 quarters of the year, earnings were up 78%, and expectations as we wrap things up are that earnings will be up about 40% for the fourth quarter. So the year-to-date 78 will come down a little bit, but certainly we've had some good earnings growth. This is literally an equation of price divided by earnings. So if price remains the same and earnings continue to grow, the valuation will become cheaper through multiple expansion. If price increases and earnings stay the same, I think that would be more of a concern. And this leads to our next slide, which, I would argue is the most relevant slide when you're thinking about the US equity markets. It's a long been an adage that stock prices follow earnings. And the line here is the SP 500, which we were just looking at. And the blue shaded area is the SP 500 earnings, and on the right scale per share. And if stock prices follow earnings, we're doing okay. I mean, it is 20 times earnings. It is full, but you can see that the stock prices haven't gotten extended and ahead of earnings, which is what you can see a little bit of in 2020 as an example of when you would be concerned. But I think the reason obviously price had gotten ahead of earnings was the expectations of what 2021 was going to look like as compared to 2020. But this would indicate that we're not in an absurd dislocation of earnings, and so we feel pretty comfortable that this is a market that, while not cheap, it's also not or it's not expensive. And if you look at the breakout of what's contributed to the stock price or the SP 500 performance, there's a significant number of companies below the top 5 market cap companies that give us a universe to find really good companies at attractive prices, even here. So we looked at the U.S. Market. We want to obviously, where are the other markets and how are they doing? So here is a comparison of the U.S. by the SP 500, developed markets by the MSCI EFA, and emerging markets. And as has been the case for quite a while, if you're looking back over the last year at least, and actually further, the U.S. market has outperformed emerging and developed markets. It's not a new story, but it also suggests that if you're looking for maybe some relative better valuations or relative to the U.S., maybe some opportunities over the medium term that developed and emerging markets might be where you want to look. And sorry about that. And similar to us looking at the SP 500 alone, where are these, from a valuation standpoint, where are these markets trading? This has also been a consistent story for a while across this chart. U.S. has consistently been more expensive than developed and emerging markets. It has also been consistent that it's been a good idea to build some positions in developed and emerging markets because of it. And we've certainly been doing that at Townsend on the opportunities that we have, and on the opportunities in which individual clients are comfortable doing so. And it also adds that level of diversification over just purely the U.S. markets. So just wanted to start getting into a little bit of discussion of, expectations of markets, volatility, and trying to time those markets. This is looking at the S&P 500 and looking at the number of 5% pullbacks in a given year. And so this is by year, how many of those 5% pullbacks happened. Probably the most obvious example is 2020 here, where with COVID, there were 12 days in which we had 5% pullbacks. Well, the dotted line is the average, which is 4.5 times that this happens. And, we're obviously below average. And if you look at the last number of years, there's almost a built-up expectation that more of these should be occurring going forward than have happened in the past. There are a lot of variables that would suggest that would happen, mainly new activity or new expected activity from the Fed. You're adding more uncertainty to the markets, and that obviously lends to probably a greater expectation of volatility. But if we just start in, so here's 2015 down 3, 26. So 2017 had 0, and the market was up 22%. 2018 had 8. The market was down 4. So a little bit increased volatility, and in total, the market was down 4. And then 2019, we had 2. The market was up 31. 2020, the market had 12. It was up 18. And 2021, we had 1. Market was up 29. And so far, in 2022, we've had 2. But just a side note on financial headlines and financial reporting, there's been an increased attention to the number of points switching from the S&P 500 to the Dow, which is a completely different index, a much less representative index to the market than it was when it originally was created, and also calculated differently than the S&P 500. But there's been an increased focus on the number of points the Dow is down in a certain day. And, it's 600, it's 700, it's 800, it's 1,000. And obviously the headline is written that way because it sounds like a lot. Well, the Dow is a 33,000 index. And to have just a half a percentage point move, you're going to be in the hundreds of points. But just relating it here to the S&P 500, and I'll just use the assumption that there's 4.5 times that it happens a year in the Dow as well, probably a little bit less, but a 5% pullback, which this chart for the S&P 500 would tell you that it's not abnormal. Today, a 5% pullback in the Dow would be 1,650 points. And my impression is that the financial press would go berserk with that to happen. And if it did happen, it's honestly not out of the realm of being normal. So just wanted to make sure we were trying to keep a perspective on the perception of dire headlines versus maybe just some reality of math and what that would mean. And so touching maybe a little bit more closely to timing the market. So this is $1,000 invested over the last 25 years. And that's the green bar. That's if you did nothing. You put $1,000 in 25 years ago, and here we are today, you have $4,300. Each subsequent blue bar, is the number of missed best days in the market for those 25 years. And I just want to try to relate to the idea that, there's a bad day in the market, or there's a bad few days in the market, anxiety levels increase, the need to make a decision increases, or the perception of the need to make a decision increases, and we want to get out. Well, every get out decision comes with a get back in decision. And that's why I think this resonates so much, is that, this is telling you that over the last 25 years, if you would have missed, and to the extreme, if you would have missed the 40 best days over the last 25 years trying to manage the fear of near-term volatility and thinking that an individual investor can get out and get in and protect their assets and still grow their assets. If you miss the best 40 days, your $1,000 would be $500. Now, I think it makes sense that you go, well, of course, if you miss the best 40 days, of course, you're going to not perform that well. Well, over a 25-year period, there are 6,250 trading days. So by missing the 40 best days, you've missed less than 1% of the trading days that were available over that 25-year period. So hopefully that's just trying to give an idea that it doesn't take much to not only lose your capital, but not earn as much that you could have earned if you just rode, just stayed the course. Just another example of staying the course. I think there is, I know there is at least some of our Townsend clients an idea that, or a fear of a 2008, 2009. We do not feel that that is a concern. The market is structured completely different. Banks which were the culprit of 2008 and 2009, are in a much more stronger position than they were then. But this basically takes the 2008 and 2009 market and has different scenarios based on what you did at the end of that period. And I think what we're trying to drive home is if you just wrote it out, didn't do anything, you would have 7 times your money on a $1,000 investment. And if you just moved to cash for a year, you drop to 427. And if you move to cash and said, I'm terrified of the market, you would be up 30,000 bucks. But I do agree that 08, 09 market was terrifying, and it really probably drove a lot of consternation and concern. But even then, were you able to do so? It was a much better idea of just sitting still than it was to try to, manipulate your returns or your assets by trying to get out, get in, get out, get in. Kind of switching over to discussion on rates in the Fed. Just for data purposes, at least, this is the yield curve currently. The blue line is at the top. The orangish, assuming you can see these colors well, orangish, or the middle line, was last quarter, meaning December 31st. And the red, or the bottom line, mostly bottom line, was 1 year ago. With the Fed's the Fed's comments over the last couple of months, and frankly, removing the term transitory from their discussion on inflation, you see that the 2-year has really escalated, almost performing the job of a Fed funds rate increase. More recently, it's in the 170 range, and the 10-year is close to 2, if not just over 2 now. Again, the standard look at the yield curve over different time frames. This is a look at the historical interest rates with the 10-year and the 2-year. Reason we're looking at that, the 10-year rate is really used for it's the benchmark for most consumer lending, where the credit cards or mortgages, and the 2-year just near-term expectations. And you can see the 2-year reacting to the Fed's comments recently, but more, at least wanting to bring your attention to some of the historical rates. If you think back, and people, the idea of the expectation of higher rates and where they could go, and what that means for the markets. But if I could, and hopefully this works, I wanted to bring attention to the roughly 2013 to about 2014 period, where the rates, the 10-year went from, I'll call it 175 to 304. And the idea that rising rates punish markets, well, typically rising rates, if it's a controlled environment, suggests that there's economic growth, and that's good for the markets. And in fact, the S&P 500 over this time frame was up a cumulative 53%. And if we come back here to 2016, I'll call it middle of 2016 or the start of 2016 through after 2018, where you had a similar, 1.5 to 3, little over 3 move in the 10-year. Ironically, the S&P 500 was up a cumulative 53% over that period as well. So when you're evaluating the equity markets and rising interest rates, it's important to keep some things in perspective, but also be aware that just because something happened in the past, it doesn't necessarily mean it's going to happen in the future. We're certainly in dynamic times right now. Longer term period of looking at historical rates with the 10-year and the 2-year. Again, recognizing some, where rates were, back at some historical timeframes, and that it seems we're certainly working our way back to those levels. Corporate bond yields across credit ratings. Historically, AAA to CCC, which would be considered high yield, or I guess the word used before the Wall Street figured out it made people nervous, junk bonds. So they changed the name to high yield. But investment grade bonds or anything that are BBB or higher, and anything below BBB is quote unquote non-investment grade. But certainly you're starting to see, an escalation in some of these rates as an expectation of rates increasing as we look forward over 2022. Here again, really just illustrative of the federal funds rate where it is currently, which is essentially zero. Some historical perspective of where it was over certain historical timeframes, including Lehman Brothers, but also, at least for now, forecast of where those that are making the decisions think the Fed funds rate would be in the future, with 2024 settling in around 2%, but also an expectation of that continuing to move higher. This typically would not put this in a presentation, but again, given the focus on the Fed, this is what's called the Federal Reserve dot plot. So if you can see these blue dots, hopefully you can, these are the individual FOMC member projections. So each member makes a projection of where they think interest rates are going to be. It's the end of 2022, at least for now. From the last update, we're just slightly less than 1 for the Fed fund rate, starting from 0.125. And we end up longer term at about 2.5. But I think the cause for pause or concern, I don't know if concern is the right word, but the pause or the cause for attention is, I want to point out that as you get further and further out, these dot plots get farther spread out. So there's clearly, so for 2024, there is someone, so there's a member that believes that we would be at as much as 3% on the Fed funds rate from where we are now. So just again, wanted to show this, given the attention to the recent comments from the Fed and people's focus on the Fed, but this gives you an indication of at least what those people that are making those decisions are thinking right now. I think this is really the biggest wild card of the current environment. Fed's balance sheet. This is the QE, the quantitative easing lever that they pulled. They've been buying U.S. Treasuries and mortgage-backed securities and building their balance sheet now to a record, essentially $9 trillion. They have talked about not only are they stopping the bond buying, which will be done at the end of this month, but at some point they're going to have to start reducing that balance sheet. And to the scale of $9 trillion on the balance sheet, no one really knows the explicit impact of the size and scale or pace at which the Fed will reduce its balance sheet and its impact on the market. There's no doubt it will be restrictive. There's obviously many different opinions about to the extent to which it will be, but this is certainly a new aspect that needs to be paid attention to and will impact how people are investing or what you're hearing about investing and how to protect your assets in doing so. But the point is that it's now just not a Fed funds rate story, it's a Fed balance sheet story. And the Fed balance sheet story is a new phenomenon. So just, again, really just putting this in as illustrative. One of the ways that some investors have talked about gauging the value of the equity markets is comparing the U.S. market cap of stock market to GDP. And it's the same example of the prior slide where I said the most important slide is price to earnings. As long as price is following earnings, this is considered GDP to earnings. And obviously the market capitalization of the entire stock market being the price. If the price gets too extended relative to the overall GDP, which would be the earnings, you've got a period in which you should be concerned about valuations. But here, looking at this as far as debt, on a net debt basis, we're about equal to GDP from a debt standpoint. If you look globally, there are other countries that are way worse, and I would point your attention to Japan as the most extreme example. But it's just, there's been a lot of, the government's raised a lot of debt, and this is an ongoing topic of concern for the market as well. Consumer price index. This has been, gets reported on a regular basis. I'd be surprised if you guys you haven't noticed where this is. I mean, the most recent reading was 7.5 on core, and 6 on core, which excludes food and energy, and 7.5 on an absolute basis, which is a 40-year high. A lot of things drive this. A lot of talk now about supply chain and wage inflation, those kinds of things, pushing prices in food. When I did the original live presentation a week ago, I made jokes that my favorite food, bacon, is up 18% year over year. Used cars are up 40%. So while it's 7.5% on average, there's certainly those products and commodities that are much higher than 7.5, but then obviously some that are less. But this is one of the biggest measures or indicators that the Fed's using to justify its recent comments and thoughts about any changes in trajectory of their decisions. Wanted to throw this in quickly. Leading economic indicators over time. Main thing I wanted to argue is and why you should have a level of optimism is that it's still, while it's come down, it's still positive. And more importantly, if you look, except for 2020 when the world shut down almost overnight, I think it's important to notice that the leading indicators turning negative doesn't necessarily mean that you're automatically in a recession. If you look at these past indicators, the leading indicators are negative for a period of time before it's actually determined that you're in a recession. And one of the most famous lines is that by the time you figure out you're in a recession, you're probably already out of it. But the bottom line being that one, we're positive, and two, even if we were slightly negative, it doesn't necessarily mean that you're going into a recession immediately. Each one of these time frames has a period before a recession is actually in place. And so being positive currently, being aware of the trajectory, but being positive currently is a good sign. And here we wanted to transfer to a discussion about the consumer. So this is household net worth. And obviously at an all-time peak, this means that consumers have money. They're in a good financial position. They have the opportunity to increase leverage or debt, i.e. credit cards, mortgages, etc., which are money multipliers. So, as we look forward, while there certainly are headwinds that are obvious and real, I think the underlying health of the U.S. consumer is a real positive. And as we switch to the next slide and last slide, the household debt service. So this is the amount of income that is used to service debt. And you can see that hopefully you can see the lightly blue dotted line that shows that the average of household income that is used to service debt is around 11% of that income. We are far below that as of now, and gives us, just to get back to average, gives us ample room for increased spending and increasing consumption as we work through some of these issues. So just wanted to wrap up thanking you for your time. If there are any questions that you may have that arise from the presentation, I would encourage you to reach out to us at 919-782-9689. And you can ask for myself or Gerald or anyone that may be able to answer your questions. Again, I appreciate you spending your time with me. Hopefully you felt it was useful and that it was a length of time and a level of information that wasn't overwhelming. But thank you, and we'll see you again next time. Thanks.